Everyone, this is Connor Tomkies. I'm here recording. We're just going to be on the Made It podcast YouTube channel. It's also going to be inside the Entrepreneur Cooperative group for all the members to access and be able to reference. I'm here with Michael. Michael is an expert in all things wealth, and he's going to be sharing a little bit about his background, the firm that he's currently working with, and we're going to be jumping into some questions for some entrepreneurs that are considering an exit, and then also some things that you might want to set up for your own estate and trust. So Michael, it's good to have you, and I'm going to hand it over to you for some introductions.
Sounds great. Thanks for the intro, Connor. I was telling Josh earlier, I think Made It is a good name for the podcast, but I also like kicking it with Connor.
It's kind of casual.
If you're ever looking at changing the name. But anyways, so yeah, my name is Michael Schulte. My firm is WestPac Wealth Partners. I've been with them since I graduated from UNLV back in 2012. So I'm both a young and an old 35 years old, starting this business at the age of 21. So the reason I joined WestPac Wealth Partners is when I was interviewing at wealth management firms coming out of college, everything sounded the same except for what we were going to be doing at WestPac, which was helping business owners with the gray area between their personal balance sheet and their business balance sheet. Because as a business owner, everything blends together because everything that you do in your business is ultimately for the benefit of your personal balance sheet. But you also need to structure your personal balance sheet in such a way that you always have that flexibility with your business and the business is never starved, right? So you can't separate one from the other.
I think a lot of founders, they're in survival mode, right? They're in survival and they're in growth. And so they're so focused on what do I need to survive? What do I need to grow? Until you get to the point where there is an exit and there's a liquidity event. For a lot of people that sell their business, a lot of times they put all of their net worth back into the business to grow and scale it. And there's not always a lot sometimes left over to be thinking about long-term things until you get a massive liquidity event and then you have $10, $20 million landing in your account. And so one of the things I wanted to ask you, Michael, was what should your first three moves be if you are going to have that big infusion of capital coming in, let's say, 6 months?
All right, that's a great question. Let me see if I can break it down to just three of them. I would say the first one, and this is especially critical if you are, I would say, age 50 or older, all right? Because odds are you're not going to sell this business and then go start another one and build it up, right? You're closer to retirement age.
Right.
So I would say the main thing if you're in that situation is we need to hone in on a retirement income plan. Are you selling your company for enough money to where it will fuel your retirement for the rest of your life? That's critical because if it can't do that, we might need to focus on increasing the value prior to the time that you sell the company. So retirement income planning, critically important. Step number 2, estate planning. All right. If you're having a liquidity event, and this is something, what if it's 6 months, great, we can still do some things. But if we can do the estate planning 5 years in advance of the exit, it can be even more powerful for reducing future estate tax.
Yeah. Why do you say 5 years? Right? Because that's a pretty long time to have that much foresight.
Right. 5 years is safe, right? But what I'm actually looking to do, if we are working with a business owner and they have let's say it's a company worth $20 million and we have a decent amount of time prior to the exit, we can use things such as a minority discount and a lack of marketability discount to gift or sell the company, part of the company, to a trust and move it outside of the estate tax system. All right.
I think that makes sense. I heard that number was closer to 6 months before a transaction, but is that kind of like a gray area? How does that normally work? Does it get challenged? Right. And the reason why this matters, guys, is if you have a company and you're trying to put it into the trust, it's hard to say how much. I imagine that the minority discount and lack of saleability discount it's not liquid, right? It's hard to mark a value to that company. And what you're essentially trying to do is move this into a trust or a sphere where then you can pass it on to your children, your children's children, right? Without them having to go through a massive tax bill, right? Whenever you pass away. Is that the right understanding of it, Michael?
Exactly. Right. That's a great description of it. It's gray area. 6 months is, I would say, a little bit on the questionable side.
Yeah.
A year, I think, is rock solid. Now, the reason I said 5 years is if we go 3 or 5 years pre-exit, Now we have that 3 to 5 years worth of growth in the value of the company from 20 million to whatever you end up getting when you sell it. That is also outside of your estate, right? So if you gift or sell your company at $20 million, you get the minority lack of marketability discounts, reduces the gift amount down to $12 million. Now you got a $20 million asset outside of your estate for a $12 million value. Now, let's say over the next 3 years, you doubled it and now it's worth 40 million. That is now $28 million of wealth that is outside of the estate tax system forever.
I think that makes a lot of sense. And so a lot of this is what we're talking about is saving money for our children down the line. Is there anything that we can do to save money from taxes at the time of the transaction?
Yeah, there are some things. Actually, Becca, if we also go 5 years, a reason that could be important as well is we could do under current tax law, we could do something as far as a S to C corp conversion,
Hmm.
but
And
we do
do a
need a 5 year
QSBS.
time period for that. And then we have the $10 million capital gains tax exclusion.
What we're talking about is QSBS, Michael. Can you tell them a little bit about what that is at like a high level?
Yeah, so at a very high level, because I don't want to get into the weeds too much on here, but under current tax law, if you sell a C corp that is worth less than $10 million, you have the tax advantage of being able to significantly reduce your capital gains tax bill and get the immediate step up when you're selling the company.
So this is huge. So the tax savings is 10 million, but I think it's also 10 million per person, or is it three times the basis or five times the basis? Do you know, Michael?
I'm not sure off the top of my head whether it's 3 times the basis or 5 times the basis, but yes, if we're talking about a C corp held by multiple owners, yeah, it can be $10 million per person.
This is important. So, like, there's something I do recommend that you guys look at is QSBS. You do have to convert to a C corp. You do have to hold 5 years. It is a little bit of a gray area. It's not heavily challenged, right? But you can also do something called QSBS stacking, where you can do for yourself, for your spouse, for your kids that are inside your trust and each beneficiary, and that's 10 million for each. And it's a little bit of gray area, but it's massive. If you have a wife and kids and set up correctly, that's up to 50 million in tax savings if you stack it correctly, which is a pretty large number.
Absolutely. And one thing, Connor, with this and for our audience, obviously, as you know, there's the potential for a new big, beautiful tax bill that could end up being a small, decent tax bill. Whatever ends up happening, you're going to want to get with your tax and financial advisors once it gets passed, whatever ends up getting passed, to see what has changed from current tax code to the next tax code and make sure this type of stuff still applies.
Michael, for those who are looking at estate planning and getting this stuff set up, how much should they allocate to setting up their irrevocable trust and a revocable trust structure for this?
Yeah, so that can vary quite a bit. And just so everyone knows, in the world of estate planning, my job, what we do at WestPac is estate and legacy planning. We're not the attorneys that are actually going to draw up your estate plan for you and do all the legal documents, right? But we deal with it enough that we know what the potential costs are going to be. If we're looking at one irrevocable trust to go along with one revocable trust, we could be as low as $15,000 total for the estate plan. The more complex we get, the more trust we add on. It could be all the way up to $60,000. So I would say that's your general range, somewhere between $15,000 and $60,000.
There's some benefits setting up the trust besides just being able to pass your estate down to your children without triggering a massive tax bill for them. Can you walk through what some of the benefits are of having an irrevocable trust in the first place?
Absolutely. So I would say in today's environment, with the estate and gift tax exemption for a married couple being $30 million, the most important feature of an irrevocable trust is going to be your asset protection benefits. So let me go to just the three levels of trust planning is be a revocable trust starting with an R. The primary benefit of a revocable trust is going to be probate avoidance. Right. The next area of trust planning is going to be asset protection planning. Now, if you have a fully irrevocable trust, you're going to have estate tax benefits and you're going to have the asset protection benefits. But there's a middle area. There is 19 states in America that allow for what's called a self-settled asset protection trust, which means that you can be the grantor and you can be the investment trustee. So you can have all the same elements of a revocable trust where you have a lot of control. But if you separate out one of the trustee roles, such as a distribution trustee, and you name another person inside of that asset protection trust as a distribution trustee, or you utilize a trust company to be the distribution trustee, you can have inside of that trust full asset protection on it.
Can you tell me a little bit around the different roles that are involved in a trust? So for the people listening to this, they might not have a trust set up yet, and they're wondering like, what does this mean to be the beneficiary versus being the manager versus being right? Like, what are the different roles?
Awesome. All right. So we have the grantor. That is a person that creates a trust. We have three different trustee roles. We have the investment trustee. That is a person that makes decisions around what happens with the assets that are inside of the trust, sell them, buy new stuff, whatever we want to do with the money and the assets in the trust. The investment trustee decides what happens there. We have the administrative trustee, which handles all the administration of the trust. And then we have the distribution trustee, which is going to be the person that distributes money from the trust into the person's estate back into their regular world. So in a revocable trust, the grantor is also the investment trustee, administrative trustee, and the distribution trustee. In an asset protection trust, and they're also the beneficiary. Don't want to forget that one. So the beneficiary of the trust in a revocable trust is the same as a grantor, the same as a trustee, same as a beneficiary. You, as a creator of the trust, are all of them. In the asset protection trust, you're most of them, but you can't be the distribution trustee if you actually want to have the asset protection benefits. And then in a fully irrevocable trust, the beneficiary has to be someone else. It can be your spouse. It can be an adult child. It can be a charity. Right. There's different ways we can get it. And now, if it is your spouse, and if you structure it with what's called a floating spouse provision, what I refer to this type of trust is, some would call it a hybrid domestic asset protection trust. I just refer to it as its legal name, which is a spousal lifetime access trust.
And this is called a SLAT, right?
SLAT. Yep.
SLAT.
For it. Yep. SLAT. So you set up the trust. It's for the benefit of your spouse. So you are the grantor. You are the investment trustee. We've separated out the distribution trustee to another individual that's not involved with the trust in the state that you set the trust up in, or a trust company in that state. And then your spouse is a beneficiary, while also having a floating spouse provision, so that if you do end up getting divorced, your ex-spouse no longer gets all the money from your trust, and you can indirectly access money from your spouse for the trust. Right. So that's as close to full access and estate tax protection as you can get.
For that reason, you most commonly, like I most commonly see these SLAT or the spouse one used a lot of entrepreneurs, right? Because it's close, it still fits all the different criteria, essentially. Is that what you see most common?
Yeah, especially if I would say, I mean, that's pretty. Now, having what's called an intentionally defective grantor trust and having a business active adult child being the beneficiary of that trust, I see that structure as well. Yeah. But if there's not business active adult children, a SLAT is right about the only thing that actually makes sense for an operating business to be owned by, as long as it's a discretionary trust, which means you have full discretion for distributions from the trust, and you have a floating spouse provision on it. So as long as we have those protections, it's a very flexible trust and protective trust for business owners to utilize for their operating business.
Michael, let's talk about distributions and let's talk about the trust structure a little bit because for a lot of people, it's like this amorphous kind of like entity, right? So what can you use the trust to for? What can you pull from the trust as a beneficiary? What are the different categories? And then how would you go through the process of pulling money out?
Awesome question. So there's one, I would say this is pretty common on about 90% of trusts. It's not the structure that the attorneys that I use prefer, but it's the structure that traditional planning takes on, where you can pull distributions from the trust for what's called HEMS, which stands for health, education, maintenance, and support. All right. Now, if we squint our eyes and shake our head, Connor, that could actually include everything, right? But if for whatever reason our I's aren't dotted and our T's aren't crossed on that, that could get challenged by a creditor or it could get challenged by the IRS for estate purposes. And if it wasn't done properly along the way, then all the advantages of asset protection or estate tax protection can be voided out. Now, another way we can drop the trust is what's called a discretionary trust, where the grantor and the beneficiary have full discretion for what they're able to pull from the trust for distributions, as long as it's done within reason. Now, if you are using your irrevocable trust as a piggy bank to fund your personal life, that's not going to work. That's going to get challenged by creditors or the IRS. But if you're just pulling a annual distribution and just letting the trust company know that you're doing it, you're totally fine as long as a trust is written properly.
I think that makes sense. And so for like an entrepreneur that has that, let's say that $20 million exit, you don't put, or maybe correct me if I'm wrong here, you don't put all of it into the irrevocable trust. You put some of it into a revocable trust, a lot more flexibility, and then you put a portion into the irrevocable trust. Can you tell us about what that split is and why that split exists in the first place?
That's a great question, Connor. So a couple reasons. I'm going to go with what's actually the most important. This goes back to step one for an exiting entrepreneur. I mentioned retirement income planning. We want to be able to fuel your lifestyle for the rest of your life via what's owned by your revocable trust. All right. That way we can just separate legacy from lifestyle completely, and everything for legacy is going to then go into the irrevocable trust. That way we do not have to rely on distributions from the irrevocable trust to live your lifestyle, right? While you're able to take distributions as needed. Like, for example, typically we set these up if you're setting it up as a grantor trust, which can make a lot of sense if you're in a low income tax state, then your personal estate is going to pay whatever income taxes are due from the irrevocable trust, right? So we want to, at the very least, get that distribution at the end of each year from the trust into your estate to pay the income tax, right? So distributions are allowed, but we don't want to rely on distributions because then we're just kind of draining the trust. What's the point of setting up the irrevocable trust if we're just going to live off of it? Does that make sense, Connor?
I think that makes a lot of sense. And so that split is different for each person because each person has different spending habits, different retirement plans, right? And so that split between how much you put into your revocable trust versus your irrevocable trust, it might be more of a factor being like, how much are you spending normally each month? What type of lifestyle do you want to maintain? And then kind of going from there. One thing that I was looking at, and this is a question I received last week, was at what size of wealth should people be considering this? And this is a loose ballpark, right? Is like at what point in the United States for an entrepreneur, at what size of exit do you think people should talk to you or talk to another wealth advisor?
All right. So a couple different to think about there. As far as talking to just a wealth advisor in general, I mean, really at any amount of value from the exit, you should be, if it's $1 million, that's $1 million. That's a lot of money. You're still going to need to figure out the most efficient way to turn that into income for you in the future while maintaining liquidity and achieving all of your life goals. If we're talking about asset protection, advanced estate planning, estate tax protection, I would say if we want to kind of give a ballpark number there, about 5 million you should start thinking about maximizing your asset protection. Estate tax protection, I'd say right around 10 million. Now, you might be thinking, Connor, well, 10 million. I mean, if the estate tax exemption is 30 million for a married couple, why 10 million? And my answer to that would be at about that number, we need to at least be considering it because the estate tax exemption for a married couple right now is 30 million, but it only matters what it is in the year that you die.
Right.
And we don't know what it is, what it's going to be in the year that you die, because we don't know when you're going to die and
Yeah.
we don't know who's going to be the president. All right. So we need to have that flexibility in the future of being prepared for anything.
I think that makes sense. And like it does depend. So like during Trump's first term, right? We weren't sure what was going to happen when the next president took over. Now it looks like it probably will be extended, more likely than not, right? Or expanded. I wanted to ask a few more questions while we have time, talking about things for, so let's say that you're still looking for, you maybe don't qualify or you do qualify for QSPS, which is great, right? Is there any other tools that you recommend that might help alleviate that tax bill? So this could be talking about charitable remainder trusts. It could be talking about, I might need you to help me with the environmental, geez, Michael, which is the one where you dedicate land to be protected easement.
Ooh, I know what you're talking about.
Yeah, environmental easements.
I don't know if that's technically what it's called, but
What is it called?
are you talking about the one where you are able to avoid property tax?
No, this is so like you can. I'm going to slaughter this, and I maybe shouldn't be talking about this if this isn't down our alley. But there is conservation easement. So there's a conservation easement. You donate land to conservation, and you essentially write off the maximum value of that land that you are donating. And so you have to do a conservation easement study, looking at what the value of it, make sure it's defensible. It might be a good way to raise a flag and say, please audit me, the IRS, but it is something that you can look at doing, which is interesting. But yeah, do you have any exposure on conservation easements? We might want to ease away from that one.
Yeah, no, I don't deal with them a ton, but that could kind of be lumped in with the benefits of like a charitable remainder trust
Right.
as well, right? The thing with charitable remainder trusts, things like conservation easements, there is a level of finality to it,
Hmm.
in that it's done. You don't control what you just donated to that, what assets you just donated to that charity anymore. So with me being 35, my clients tend to range a bit younger. If I were to look at the average age of my client, we're probably in the low 50s. Right now, I have clients that are retired. I have clients that are in their 20s, right? So it's a really wide range. I have a hard time being fully on board with things like charitable remainder trust, despite the income tax benefits that could come from it. Especially if you were to sell your company to a charitable remainder trust, the exclusion from capital gains tax is in some cases can be up to you're not even going to pay any.
Yeah, just really quickly, I think we need to tell people what it is. You put your assets into a trust, and then that trust pays you income off
Mhm.
of that for a term of years or for your life. And then when that term ends, the remainder goes to charity, right?
Yeah.
But the advantage is that you get that upfront value of as essentially a tax write-off, right? Which is a little crazy to see.
Yeah, no. So if you're 65 years old and your life expectancy is right around 85, and that income for life from the charitable remainder trust is going to be $400,000 a year, this can be really, really advantageous. But if you're 47 and you just sold your company, there's so many decades left of your life that it can be better to, even if we're going to pay more in capital gains tax, to have that control over more of your assets for the foreseeable future, in my view, is more beneficial than reducing the capital gains tax the full amount.
Yeah, and it's interesting because the people that I know that do this, they sometimes have a hard time finding a charity to help be the backer for that. It requires like some paperwork on their end. Some of them might
Yeah.
not be comfortable with it, right? But it is very interesting as far as like a way to alleviate tax burden. It's also has like a little bit of a philanthropy bent. It's weird because like you're getting distributions from it and they might get it 20 or 30 years from now, but
Uh,
eventually it does go there, right? Like at
yes.
some point.
Yeah. Another Right. So just the finality of the charitable remainder trust, conservative easements, it can be very tax advantageous up front, but there's strings attached to it.
Mhm.
Another solid tax benefit, if we're looking 6 months pre-sale, that could be advantageous is you could potentially sell your company to what's called an ESOP, an employee stock option plan. So if you are a C corp, you can use what's called a 1042 exclusion, and you can sell your company to the employees through an ESOP, and then you can invest the proceeds through Section 1042 in US stocks and bonds,
Mhm.
and you can defer capital gains entirely doing it that way.
That's huge. And I love this. We had a whole talk about this at the Entrepreneur Cooperative, I want to say like 6 months ago. I think it's amazing. People that help you. I'm not sure if this is something that this is probably outside, Michael, what you guys do as far as setting up the ESOP, right?
Yeah, no, we don't set up the
Yeah,
ESOP. We can help coordinate how that's going to be handled. We have relationships with people that do set up the ESOPs.
what I do like about this is that you can do it gradually. You can do it like an infusion, like a more sudden kind of like issuance. And like I do like it. There is so that's the good side of it is I love employee owned businesses and I think it's fantastic. The dark side of it is that there's been people who set up the ESOP, the company goes down in value because they don't have the right management structure in place or something like that. Then they go back and buy the company again and
Mm.
take it over. I've seen it 3 times, which is a pretty surprising number, but it is interesting to see that happen. It can be hard to pull off sometimes.
Sure. Yeah, I mean, this makes literally no sense, but I would say ESOPs are both underutilized and overutilized at the same time, right? It's all about the fit of the company for the ESOP itself. There, I would say realistically, of all the companies in operation in America, probably about 5% of them at the most could be a really, really great fit for an ESOP. And those 5% that are, less than 1% of them actually know what an ESOP even is. Right. But then for the other 95% of companies to use an ESOP, it could end in a lot of administrative headache and potential disaster if it's done in the wrong situation.
Yeah, I think that's a good way to put it. Really good idea. I love I love the concept. It's it kind of depends a little bit on your management team that you currently have. Are you
Mhm.
set up to be able to hand this off and have them step up, which would be great. Michael, is there other tools that you look up or things that people should consider, but like kind of fitting into that tax strategy piece?
I mean, we've already hit on a bunch of them. There's certainly many, many more good ideas, right? I would say the key is, do these particular ideas, are they a fit for your business and are they a fit for your personal balance sheet, right? So it's critical to have the right financial team around you to help you with all these ideas because there's so many of them out there.
Let me ask you something that's very with what you do, but what should founders look for in a wealth advisor, and what are some red flags whenever you're interviewing someone to help manage your finances?
So I would say what they should be looking for is an understanding of what the life of a business owner looks like. And is that wealth advisor able to speak your language? Are you able to be comfortable with them?
Hmm.
Red flags to me would be someone who is, I don't want to say, I mean, product pusher might be a little bit aggressive, but sure, we'll go with someone who's just a product pusher, right? That just everything's a nail and they're going to give you a hammer. That's not really applicable to business owners. So I would say another way to put that would be, you want advisors in your corner who are able to take a macro approach and a high level view to your balance sheet to help you build strategy that's going to maximize your net worth in the future and also help you prepare the next generation to take over the legacy that you're going to be leaving. That's really important. A lot of financial professionals fall into a micro view and they're just good at one or two particular things.
I think that makes sense, Michael. And there's also like different focuses, right, for different firms. And we didn't talk so much about like asset allocation, which is also pretty important. Do you have any recommendations around different types of asset allocation models that you see most common or that you recommend to folks?
Yeah, that's a great question. I mean, that could be an entire
Whole thing.
podcast in itself.
We do an investment meetup that's around this topic, but
Yeah.
yeah. Do you have anything that you see on like a high level?
Yeah, so my background is in factor-based investing. That's what I'm partial to. That's what the last 100 years of data would suggest is the best approach for investors is to be globally diversified,
Hmm.
own equities, and tilt toward those factors. And those factors would be stocks historically outperform bonds, small companies historically outperform large companies, value companies historically outperform growth companies. Then the fourth factor is that profitable companies historically outperform unprofitable companies,
Imagine that.
right? And by the way, of those factors I just mentioned, that's actually in the last 10 years, that's the one that's been proven most recently. Now, a lot of that is when we go back to the 20s, 30s, 40s, 50s, 60s, 70s, and 80s, right? Being able to gather all of the data necessary to prove some of these things is a very difficult task. So it took a long time to have enough data for these professors in finance like Eugene Fama, Kenneth French, Harry Markowitz, the guys that won Nobel Prizes for proving this type of stuff. It just took the longest time to get that one of profitable companies outperform non-profitable companies, right? But as we're building our portfolios, that's what we tilt toward, right? Now, that doesn't mean we eliminate unprofitable companies. It doesn't mean we eliminate large growth companies from the portfolio, but we are just tilting toward those factors that have historically produced the highest rate of return. And then we're rebalancing systematically. All right. So we're trying to completely take the guesswork out of investing. All right. Because if you were asking me for my hunch of what's going to go up and what's going to go down, I don't have one. If I did know, Connor, we probably wouldn't be here right now. I'd be a billionaire on a yacht.
I do think that it's like trying to game the market doesn't normally work out well. And usually once you have an infusion of cash, you kind of switch more to protecting the assets that you have, seeing it grow steadily versus trying to have some big swings. For a lot of entrepreneurs, the big swings are your own business, betting on
Oh,
yourself.
yeah.
You've already gambled, right, for the past like 10, however many years to get to that point, right? So you don't always necessarily have to go all in on one tech company. Michael, I think
And
this is
our philosophy
really
is always protection first.
for sure, for sure.
Yeah.
Michael, I think this is really helpful. Where should people go to find you?
So I have a podcast called caffeineandcashflow.com. It's on Apple. You can check out my podcast there. You can find me at 702-767-4897. That's my business phone. You can get a hold of me there. You can Google me, Michael Schulte at WestPac Wealth Partners. A lot of ways to find me. You can find me on LinkedIn. Can't find me on any of the other social media stuff because I quit social media back in 2019. Do not regret it at all.
It makes it harder to run a podcast. But yeah, I agree.
Now that, and with that being said, my team is on social media. I'm just not
We're just
personally.
cheering them on.
Yeah, I'm like, hey, go on TikTok or Bookface or whatever you guys are using now. I'm 70 going on 36. So
That's awesome, man. But yeah,
yeah.
I totally get it. And if you have any questions, please feel free to reach out. We do focus topics on this. So it could be on QSBS. It could be talking about different types of trust structures. But it does save you a lot of time and it saves you a lot of money and it protects some of the things that you have, which becomes kind of vulnerable once people can go after your entire estate. Michael, I appreciate having you on and that's the pod.